This video will help you understand phase-out limits as they pertain to funding deductible traditional IRAs and Roth IRAs. If you don't know who I am, my name's Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In my last video, we covered briefly who is eligible potentially for funding a deductible traditional IRA or funding a Roth IRA. One of the barriers to eligibility that we determined were called phase-out limits. Phase-out limits are those modified adjusted gross income brackets that essentially prevent certain people from taking advantage of either a pre-tax deduction in funding a traditional IRA or funding a Roth IRA. Now, these phase-out limits cause a ton of confusion with clients, and so in today's video, I'm going to break down how you can calculate, if you're within those limits, what you can do relative to either a deductible traditional IRA contribution or a Roth IRA contribution. As a quick refresher, the IRS imposes modified adjusted gross income phase-out ranges for funding either pre-tax IRAs or Roth IRAs, depending on your tax filing status, and depending on whether you or your spouse have the ability to participate in an employer-sponsored plan. That is when you're called an active participant, and the rules are a little bit different. In all these situations, whether you're single, married filing separate, or married filing jointly as your tax filing status, regardless of what you do, there are phase-out limits relative to your modified adjusted gross income that dictate whether you can take advantage of certain IRA strategies. For a lot of people, they actually fall within these ranges, and it can get kind of confusing knowing how much of a particular IRA strategy they're allowed to take advantage of. If your modified adjusted gross income levels are well and above the upper bounds, then you will be ineligible to either take a deduction and fund an IRA or fund a Roth IRA. And if you're below those limits, you don't have anything to worry about. You can do either strategy or a combination of the two. However, if you're within these ranges, you get the opportunity to do a bunch of math to figure out how much of one of those strategies you're allowed to employ. In other words, you are partially eligible to either take a pre-tax deduction and fund an IRA or to partially fund a Roth IRA. Now, whether or not you should be doing either one of these strategies, that's a conversation for your financial planner and you, as well as your CPA. But in this video, we'll break down if you want to fund either a pre-tax IRA or a Roth IRA, what your options are based on your modified adjusted gross income levels. These modified adjusted gross income phase-out ranges change every year. Roughly, they go up with inflation. So be sure to look up the tax year specific phase-out ranges for whatever tax year you're watching this. For this video, we're going to use the numbers for 2023. Okay, so let's say you want to fund either a pre-tax IRA or a Roth IRA. You know your tax filing status, single, married filing separately, married filing jointly. And now you've determined you're within the phase-out ranges for whatever strategy you want to employ. Let's assume, for the sake of an example here, that you want to fully fund a Roth IRA, but based on your tax filing status, you fall within those phase-out ranges for 2023. Those phase-out ranges for funding a Roth IRA, if you're single, are $138,000 to $153,000, and if you're married filing jointly, those phase-out ranges are $218,000 to $228,000. So if you're single and you have modified adjusted gross income of $140,000, you're allowed to fund a Roth IRA partially. And if you are married filing jointly and as a household, you have modified adjusted gross income of $220,000, then you are also partially eligible to fund Roth IRAs. If you're above those ranges, you're ineligible to fund a Roth IRA, simple as that. If you're below those ranges, you can fully fund Roth IRAs relative to your age. And I say relative to your age because, as a quick refresher, if you're under the age of 50, for 2023, your maximum contribution to a Roth IRA is $6,500 per person. If you're 50 or older, your maximum contribution is $7,500 because you get that $1,000 catch-up contribution since you eclipse the age of 50. Congratulations. And of course, as we talked about before, you must have enough earned income to justify these contributions. So if you're 60 years old and you have $3,000 of earned income, of course, your modified adjusted gross income limits at that point are going to be well below the phase-out ranges. You didn't have enough earned income to justify fully funding a Roth IRA, even if you're permitted to based on your modified adjusted gross income. You have to make an earned income at least the amount that you're putting into these IRAs. Or as a household, you have to have enough earned income to justify these strategies. So before we get into a bunch of math, conceptually, I like to understand how much you're allowed to put into either a pre-tax IRA or a Roth IRA, depending on your modified adjusted gross income levels into the phase-out ranges. I conceptualize it as however deep you are into the ranges of modified adjusted gross income is how much less you're allowed to execute of a particular strategy. So for example, if we're looking at the brackets, your modified adjusted gross income is 10% within those ranges, then your maximum IRA contribution on the Roth side is going to be reduced by 10%. 10% into the brackets, 10% less than the maximum strategy. That's how I visualize it. We'll go on to describe the math here in a quick second, but I think conceptually that's the takeaway. Okay, so let's go through an example. We've got Archie and Edith who are under the age of 50, and they have modified adjusted gross income of $220,000. So as we previously discussed, they are within those phase-out ranges of the minimum and the maximum. They're a little bit into the phase-out ranges. But their intent is to fully fund Roth IRAs for 2023, so they're trying to figure out how much they're allowed to put in. Now, of course, logistically, they're not going to actually be able to calculate their modified adjusted gross income until the following tax year. So for example, clients in April of 2023 are calculating their modified adjusted gross income levels for 2022. And you have until the tax filing deadline, April 15th or April 18th this year, to fully fund Roth IRAs, for example. You have until the tax filing deadline. So odds are you're going to be doing these calculations in the year following the tax year you're trying to make a contribution for. But to keep it simple, we'll just assume they're getting towards the end of the year, but nonetheless, the calculation is the same, which we'll go into discuss here in a second. So first, Archie and Edith need to figure out what percentage into those 2023 phase-out ranges are they. So in order to do that, they take their $220,000 of modified adjusted gross income and they subtract from it the bottom rung of those phase-out ranges for Roth IRAs, which for 2023 is $218,000. So they take $220,000 and subtract out $218,000 and they get $2,000. Then to figure out how much $2,000 is into the phase-out ranges, they take $2,000 and they minus the delta between the top and the bottom rung of the phase-out range. So they take $228,000, which is the top of the rung, minus out $218,000, which is the bottom of the rung, and they come up with a number. And that number's 10 grand. And so what they do now is they take the $2,000 they calculated before, they divide that by $10,000 and they get 20%. So said another way, Archie and Edith are 20% into the modified adjusted gross income phase-out range brackets. That means they are allowed to do 20% less than the maximum into a Roth IRA. Or said another way, they're able to make an 80% IRS maximum contribution to a Roth IRA. That's all they're eligible for. So a simple way to do this is to take the 20% they determine they're into the brackets with and multiply that by the Roth IRA maximum contribution, which is $6,500 for 2023. So 20% times $6,500 equals $1,300. Now, that's the amount of a Roth IRA contribution that they are not allowed to make. So to figure out what they are allowed to make, you take that $1,300 and you subtract it from the total $6,500 IRS maximum. And that number will turn out to be $5,200. So Archie and Edith can, respectively, make $5,200 contributions to their Roth IRAs for 2023. And just to check our math, $5,200 should be 80% of the IRS maximum. So you can take $5,200, divide that by $6,500, and you'll get 80%. I guess to simplify the equation, you take the modified adjusted gross income for this year, you subtract out the bottom rung of the phase-out range, and you get a number. You take that number and you divide it by the difference between the top and the bottom of the phase-out ranges. That's the percentage into the phase-out range you are in. Then you take that, you multiply it by the IRS maximum contribution for whatever IRA strategy you're doing, and that will give you the amount you're not allowed to put in. So to figure out how much you are allowed to put in, you take that number and you subtract it from the IRS maximum, and there you go. Like I said at the beginning, this is not the most intuitive of calculations, but I'm hoping the concept is driven home that the percentage you are into the phase-out range is the percentage you're not allowed to take advantage of relative to the IRA strategy you're trying to implement. As we begin to wrap up, one thing I wanted to refresh our memory on is anybody is allowed to fund a traditional IRA if they have enough earned income. However, what ultimately phase-out ranges apply to is how much of that contribution they are allowed to take a tax deduction on. So theoretically, if you made $1 million, you could still fund a traditional IRA. You just won't be able to take the tax deduction most likely. Your modified adjusted gross income will be way and above the phase-out ranges. So theoretically, you could still fund a traditional IRA, and then you do your calculation to figure out how much of that contribution was deductible. And if for whatever reason you made traditional IRA contributions, but you weren't able to take them as fully deductible contributions, you'll want to track the non-deductible amount you contributed to the IRA on Form 8606. There are some benefits to purposely doing non-deductible traditional IRA contributions. We'll have to touch on those benefits in another video, but just know when it comes to traditional IRA funding, the phase-out range is applied to how much you're allowed to deduct from your contribution, and when it comes to Roth IRAs, the phase-out range is applied to how much in total you're allowed to put into the Roth IRA for that year. Okay, so hopefully that was helpful in figuring out how to do the calculation. If you have further questions, drop me in the chat below, send me an email, we'll get you squared away. Otherwise, have a great rest of your week, and we'll chat with you later. Bye.